Hello and welcome to our program on Retirement Plans 101. On behalf of Aurora Training Advantage, I would like to thank you for joining us. Your guest speaker today is Ann Dorsey. Ann is the owner of Dorsey & Company's CPAs, LLC, and the Payroll Place in Arkansas. She attended ASU in Jonesboro, Arkansas, where she graduated magna cum laude, receiving her BS in accounting and soon after her certified public accounting certificate. She has a Six Sigma Green Belt training from the Villanova University and is a member of the AICPA and ASCPA and has served on various committees for several years. Questions can be entered in your GoToWebinar control panel, and as many as possible will be answered at the end of the presentation. If anyone didn't receive the email this morning with the slides, you can download a copy in the handout section. For those interested in CPE credit, there will be a series of polling questions throughout the program, and all of them must be answered to qualify. Enjoy the program.
Okay, are we ready to begin?
Yes, ma'am. You go ahead, Ann.
All right. Well, today we're going to be talking about Retirement Plans 101, which basically means just the basics of retirement plans in general. And we're going to be covering quite a bit of material. So we're going to, I'm going to try to pace myself on the first part, and if we don't get to cover everything at the very back side of the presentation, I guess they will see that you get the PowerPoint. I think you can get those downloaded or get a copy of those. I do have some links on the PowerPoint for some additional reference material as well. And I guess if you don't get them, you can always call or email me, and I can send them to you directly. But we'll kind of pace ourselves on the front end, and there may be a few slides towards the rear end that we don't necessarily get to cover. Some of it's repeat, but some of it is new information. All right, so basically, let's talk about what a retirement plan is. So it's not necessarily just an IRA that you contribute to every year or a 401k. It's basically a plan for accumulating enough wealth, enough money that you can live off of. And usually we can expect our retirement years to be at least around 20, we hope, and depending on when we retire and how healthy we are. But if we just use 20 years as an example, then we want to be sure that we've got enough money to live off during those 20 years. And a more financial definition of that is that it is a financial arrangement designed to replace our employment income upon retirement. And there are various ways we can get a retirement plan in place. Congress, of course, wants us to be responsible, and so they've encouraged us to plan for our retirement and to save money. And so they've given us some favorable tax treatment in relation to that. So the federal tax aspects of retirement plans in our United States are based upon, of course, provisions in the Internal Revenue Service Code. These plans are usually regulated by the Department of Labor, and they're under the provisions of the Employee Retirement Income Security Act, or ERISA. Now let's talk about some major categories. There's really two major categories of retirement plans, and that's benefit and contribution, or to be more specific, a defined benefit plan or a defined contribution plan. So let's first talk about what is a defined benefit plan. A defined benefit plan is almost a lost retirement plan in the United States today, but in prior years, especially I would say 50 so years ago, these were major retirement plans. And a lot of the large companies and public companies in general kept defined benefit plans for their employees. And so the employees were very loyal to the companies as a result of it, and they would work there 30, 40 years. And then when they retired, they were assured of a potential annuity or pension payment over a period of time. So a defined benefit plan is usually based on a formula that takes into account these various factors: the number of years the participant works for the employer or the years of service, the participant's salary, and it's usually provided in the form of regular payments over the lifetime. And usually the retirement age is around 65, which isn't too different than our Social Security system. So the stream of periodic payment that they receive is usually called a pension and sometimes called an annuity. So the plan specifies how much money goes into the defined contribution plan as opposed to the defined benefit plan. Want to be sure we understand. Oops. Okay. Having trouble with my little PowerPoint here. All right. Here we go. So we talked about the defined benefit plan. Now we're going to talk about defined contribution plans. So the defined contribution plan specifies how much money we're going to put into a retirement plan today, because what we're doing is we're planning for the future. So it's unlike the defined benefit plan. And the amount is usually either going to be a percentage of an employee's salary or a specific dollar amount. The funds are often invested in mutual funds or annuities, and you're probably more familiar with this type of a retirement plan. The amount you end up having at retirement, it depends on how much your employer contributes to the plan, how much you've saved and put into the plan, how long you leave the funds invested before you start drawing them out, and how well your investments perform inside the plan. And I think the key on how well your investments perform inside the plan is a big factor in why we don't have more defined benefit plans around today, because it began to be too difficult for them to count on that average 5 to 6% per year earnings on the mutual funds, stocks, bonds, and because of that, companies were beginning to be underfunded on their defined benefit plans. So now we're moving much more toward defined contribution plans, and let's just see how much money we can put into these plans today. How much can we save? How much can I get out of my employer to match me on those funds? And then, can we make money in the marketplace over time via traditional investments? Can we obtain the 5, 6, 7% average over time? So the examples of defined contribution plans: IRAs, 401ks. So the employee is responsible to one degree or another for selecting the types of investments that are going to be in those retirement plans. You usually have a list that you can select from. So the employer signs up with an administrator. The administrator has maybe 10, 15, 20 different types of investments, and then you go through and select which ones you want to invest in and what percentage or what dollar amount of your retirement plan you want to put in those particular investments. And so it's kind of a self-directed retirement plan, because you have a choice about what you're investing in and whether you want to be aggressive or whether you want to be moderate or whether you want to be very conservative in your investment choices. You usually have to be 59 and a half before you can begin to withdraw without incurring a penalty. And as I stated, more and more employers are replacing the defined benefit plans with these defined contribution plans. Now let's talk about the different contribution plans and what is available out there. So we've talked about the defined benefit plans. Now let's talk about and look at all the different types of defined contribution plans we have to choose from. So we have IRAs, 401k plans, which 403b and 457 plans are very similar to a 401k. SEP plans, our SAR SEP plans, profit sharing plans, money purchase plans, employee stock ownership plans, government plans, and 409A non-qualified deferred compensation plans. So if we go back to the defined benefit plan just for a second, you can have other retirement plans and still contribute to a defined benefit plan, or your employer is contributing to it. You can be a business of any size. You do need to annually file a Form 5500 with the Schedule B. And let me explain these requirements, because this is more directed towards the employer side. So the employer is the one who has to file the Form 5500 with the Schedule B. And the employer must have an enrolled actuary to determine the funding levels and sign the Schedule B. And you cannot retroactively decrease the benefits. Pros and cons of a defined benefit plan is there can be substantial benefits provided and accrued within a short time. Employers can contribute and deduct more than they can under other types of retirement plans. The plans provide a predictable benefit. Remember, that's your annuity or your pension amount that you're going to receive, and you know how much that's going to be. The vesting follows a variety of schedules, and it can be spread out over 7 years, up to 7 years. The benefits are not dependent on the asset returns, and the plan can be used to promote certain business strategies by offering subsidized early retirement benefits. It is the most costly type of plan, which is another reason, and this is the employer perspective again, the reason that most employers are veering towards other types of retirement plans. It is also the most administratively complex plan. Remember, you have to have the actuary, and you have to file the Form 5500. So you have to have an audit if you have over a certain number of employees. So the audit can be costly. The filing of the Form 5500 is costly. And to have an actuary involved in order to sign off on the Schedule B are all very costly aspects. There is an excise tax applied if the minimum contribution requirement is not satisfied. Just so you know, a minimum contribution requirement is what the IRS specifies as an amount that you must take out of a retirement plan when you turn 70 and a half. An excise tax also applies if excess contributions are made to the plan. Generally, the employer makes most of the contributions to a defined benefit plan. Sometimes they do permit employee contributions. The benefits provided under the plan are limited. Remember, we covered there is the annual filing of the 5500. You can or may, the plan itself may permit participant loans, which sometimes is an important aspect of a retirement plan. And generally, a defined benefit plan may not make in-service distributions to a participant before age 62. Now we're going to be talking about defined contribution plans and that whole list that you saw underneath the defined contribution plan section on that earlier slide. The first one that we'll talk about is the individual retirement arrangements, or IRAs, and there are 3 types of those. We'll talk about traditional, Roth, and rollover. A traditional IRA is the one where you can make, they're easy to set up. You can just go into a bank, to your investment advisor, wherever, and you can say, hey, I want to set up an IRA account, and then you say, well, do you want a Roth or do you want a traditional? Well, a traditional IRA is where you make contributions to the IRA account, and those are tax deferred, which means the contributions to the IRA account are not subject to tax. So it's like a tax deduction. So you have some tax benefits that you receive immediately when you contribute to a traditional IRA. There are some income limitations. If you make over a certain amount of your adjusted gross income, it'll start phasing out how much you can actually contribute to an IRA. So you do have to be careful about those aspects of it. And generally people say, well, I'm going to do an IRA because I contribute to it now and I can save taxes, and then I'll draw it out when I retire because my income levels won't be as high, and then I can afford to pay the taxes on it then. A Roth IRA is you make contributions with money you've already paid taxes on, and your money can grow tax-free, and then you can make tax-free withdrawals in retirement, provided that certain conditions are met. So a Roth IRA is you're going to make contributions to an IRA, but not for tax advantages or tax reasons, because it's not going to be considered deferred income or a tax deduction to you in the year that you contribute. But when you pull that money out of your retirement account, now that money is tax-free to you. So the theory is, well, I'm still going to make a lot of money.